Welcome to The Explainer. Today, we are diving into a story that has Wall Street completely divided. Just a quick reminder right up front, this is for educational purposes only, so definitely not financial advice. We're looking at Tanger Inc., which trades under the ticker symbol SKT. This is a massive $4.8 billion retail real estate investment trust, or REIT, and let me tell you, its current profile is nothing short of fascinating. If you follow retail stocks or dividend-paying real estate, you have absolutely seen Tanger in the headlines lately. But as we're about to see, the surface-level momentum of this stock is masking some incredibly deep complexities.
Okay, let's dive into this paradox. Here is the ultimate question we're answering today. Is this REIT a trap or a treasure? I mean, if you drive past one of their outlet malls right now, you'll see parking lots that are absolutely packed. The physical traffic and the operational wins are completely undeniable. But if you pop the hood and look at the underlying financials, well, some of those metrics are screaming danger. It's basically the ultimate Jekyll and Hyde setup for an investor. It leaves analysts totally scratching their heads, so we really need to unpack exactly what's going on here.
So here's our visual roadmap for today's explainer. First, the Tanger paradox. Second, 7 green flags. Third, 7 red flags. Fourth, the guru stress test. And finally, number 5, the bottom line. Let's jump right in.
Starting off with Section 1, the Tanger paradox.
So, Tanger operates 38 outlet centers and 4 open-air lifestyle centers. We are talking about roughly 17 million square feet of space across the US and Canada. Sitting at a market cap of about $4.8 billion and a share price hovering around $39, it seems like a total behemoth. But here's the paradox in a nutshell. They have virtually flawless ground-level operations, but it's all sitting on top of a genuinely terrifying balance sheet. It's literally a massive tug of war. You've got operational excellence on one side and serious financial risk on the other.
Moving on to Section 2, 7 green flags. We're calling this part the polish.
Look at this massive number, 97%. That was Tanger's portfolio occupancy rate at the end of Q1. And you know it's not just a fluke, because Q2 remained incredibly strong at 96.6%. On top of that, their tenants are highly productive, pulling in $487 in sales per square foot over the 12 months ending in June. In a challenging retail environment, drawing those kinds of crowds and keeping your properties at near full capacity, that is a massive glowing green flag. And as you might expect, that occupancy translates directly into earnings momentum. Tanger reported a Q1 earnings per share beat, 59 cents versus the expected 57 cents, and they actually raised their full-year guidance. Even more impressive is their 11% year-over-year growth in core funds from operations, which is basically a REIT's cash flow. But honestly, the real crown jewel here is the turnaround in same-center net operating income. That's a key measure of property-level profitability. Back in 2019, this metric was sitting at a negative 0.7%. Today, it grew 2.6% in Q1, and management is guiding for 2.75% to 4.25% growth for the year. That is just a dramatic, incredibly successful reversal.
Rounding out our green flags, we have some serious surface-level financial strength. Now, despite the debt we're going to discuss in just a second, Tanger actually maintains excellent liquidity. They have a current ratio of 4.79x and a massive $1.25 billion cash buffer. They also rewarded shareholders in April with a 7% dividend increase, which brings the yield to around 3%. Finally, if you look at the Buffett-Fit scoring system, Tanger scores a 61 out of 100. That puts it in the top decile for REITs, beating out peers with its excellent gross and net margins. So on paper, these 7 green flags make the stock look incredibly attractive.
But now we pivot to Section 3, 7 red flags. Let's look at the poison.
Okay, here is the major plot twist. 1.13. That is Tanger's Altman Z-score. For those of you who track corporate financial health, a score this low places the company firmly in the distress zone. Now, while the Altman model was originally designed for manufacturing, an implied bankruptcy possibility within the next 2 years is a huge alarm bell for any REIT carrying a heavy debt load. In fact, this specific score ranks worse than almost 95% of other REIT companies out there.
And the warnings really don't stop there. Just look at this staggering number, 116.82%. This is their dividend payout ratio based on trailing earnings, meaning they are quite literally paying out more in dividends than they actually earn. Now, management calls their payout ratio conservative based on funds available for distribution, sure, but an earnings coverage ratio over 100% is a genuinely unsustainable situation. Income investors absolutely cannot afford to ignore this.
Then we hit the valuation and the leverage nightmare. According to Guru Focus, Tanger's Graham number, which is a classic measure of fair value, is just $10.88. With the stock trading around $39, it is trading at 3.3 times its fair value. That's 371% above its 10-year median. To make matters worse, add in a price-to-earnings ratio of 36.1 and a highly leveraged balance sheet with a debt-to-equity ratio nearing 3x. So what does this all mean? It means there is absolutely zero room for error if a broader retail downturn hits.
Our final 3 red flags show that the smart money might actually be catching on. We've seen some significant insider selling recently. 2 directors cashed out over $700,000 worth of shares in the spring. Furthermore, in late June, Tanger was removed from the Russell 2000 Dynamic Index. That triggers forced selling from index tracking funds. And finally, Bank of America Securities downgraded Tanger to underperform, explicitly citing limited upside given the current valuation. So you have institutional sentiment, index trackers, and even insiders all backing away. Let's transition to Section 4, the Guru Stress Test. Time for a framework comparison.
Let's talk about their moat. Tanger operates an open-air outlet format, which gives them incredible structural cost advantages. Their tenant occupancy cost is just 9.7%, compared to enclosed malls, which typically sit at 12% or higher. However, this moat is narrow. They just lack the sheer scale of the industry giants. Plus, as they try to move upmarket into full-price lifestyle centers, they really risk losing the very structural advantage of being the cheap open-air option that built their success in the first place.
When we run the numbers through specific Guru frameworks, the picture gets pretty complicated. For Benjamin Graham disciples, it is a hard fail. Absolute deal breakers across the board, from that 36x PE ratio to the dismal $10 Graham number. For Peter Lynch followers who look for growth at a reasonable price, it's kind of a mixed bag. Their PEG ratio, measuring price relative to expected growth, is an incredibly attractive 0.4, but that high dent and volatile earnings make it less than ideal. And for Warren Buffett followers, also mixed. They have wonderful gross margins of 42%, but a return on invested capital of just 4.2% is way below Buffett's preferred 15% threshold.
Which brings us to Section 5, the bottom line, and some actionable takeaways.
When we juxtapose the two sides of Tanger, the fundamental conflict of this stock is stark. I mean, the bull case rests entirely on high-quality, virtually flawless operations. You've got 97% occupancy, 11% growth in funds from operations, and a rising dividend. But that bear case looms so large, a questionable, highly leveraged balance sheet, an Altman Z-score signaling distress, and a dividend payout ratio based on earnings that exceeds 100%.
So, what should you actually do? Well, it depends entirely on what type of investor you are. Let's break it down real quick. If you're a Graham value investor, this is a hard pass. The valuation is just way too high. If you follow Buffett or look for deep value, put this on your watch list and wait for the balance sheet to repair itself. Income investors, you need to proceed with extreme caution despite that 3% yield, purely because of the payout ratio. However, if you are a momentum or operational investor, Tanger absolutely deserves your consideration because that 11% FFO growth and the NOI turnaround are very, very real.
We'll leave you with this final, provocative thought to ponder today. Can Tanger's sheer operational momentum and packed parking lots outrun its massive debt load and distress signals? For sure, this is a textbook watchlist stock. I highly recommend monitoring their debt reduction progress and same-center NOI growth over the next few quarters. Just wait for the evidence that the balance sheet is finally catching up to their incredible operations. Thank you so much for joining us for this explainer, and we'll see you in the next one.